S&P and NASDAQ are now on track for their fifth straight negative week. Obviously, oil remains the big story. Bottom of your screen, about $98 for WTI. Yields have been higher, too. Now, they are back almost flat, but nonetheless, the 10-year yield and that backup there, we were getting kind of close to 450. Let's take a look at yields, guys, if we could throw those up. There it is, 442. So we need to watch that. Steve Leisman says now 50% odds of a rate hike this year. Bank of America suggests we think markets are now anticipating a more hawkish Fed reaction function and possibly a broader commodity shock. Steph, I mean, the commodity shock already has been rather dramatic. It's the biggest supply disruption ever for the global oil market. There's really been no answer for that yet. And in terms of the Fed, Richmond's barking this morning. The Fed should pause, he said, to figure out what to do. It's hard to ignore the inflation data, and Phyllis Paulson was fairly similar in her commentary as well. What do you make of all that?
I mean, I just don't think anybody can make a case for doing anything right now. There's so much that we don't know. So no cuts, no raises. I'm not thinking about raises. And if we're talking about the fall, a million things can happen between now and the fall. So the headlines are coming fast and furious every single day, back and forth. And that's not inspiring confidence for sure. But there's a lot we still don't know. We don't even know who the U.S. is talking to, number one. Number two, will other countries get involved? Number three, will boots on the ground go on the ground over the weekend especially? So I understand the anxiety. I understand that people want to take risk off. I've taken a little bit of risk off, too, but I'm looking for other areas to be buying. We'll talk about that later. I still believe this to be short-lived. Spreads are tame, so that's really good. And I think it's really interesting and noteworthy that what is winning, do you know the Russell 1000 value is up 12% year to date. I'm sorry, it's flat year to date. Growth is down 12% year to date. And the energy sectors, the material sectors, even the SMH are still up. Everything that has worked in the past couple of years is not doing well. Tech, comm services, Mag 7 is down 15%.
I know, but nothing's doing well since the war started, except for the energy trade. Yeah, oh yes, that's a fact. No. Materials are down 9% since the war started.
Some precious metals are not all. There's
no,
mixed.
I'm telling you, the material sector is down 9% since the war started.
Well, since the war,
just telling you.
Oh, okay, since the war started, but year to date, actually.
Yeah, but the whole premise of this conversation and what the debate is why should we be saying, well, this is up since year to date when
the rotation started.
Yes, but the rotation has stopped on a dime when the war started.
In some pieces, energy was actually winning starting the beginning of the year. So were materials. That's why I'm highlighting it. The value sector has done much better than the growth sector. And I'm trying to give you a couple of sectors that have been working and some that aren't. We're all focused on the stuff that's not working because that's what everybody owns. And I think that you're going to continue to see a lot of pressure in those sectors because people are eventually going to unwind these positions. They haven't year to date as much because they have such embedded gains over the last many, many years. They don't want to take the taxes. So my point being is, like, we don't feel good. The overall market is down 5%, but the equal weight is flat, and there are places that you can actually put money to work or places that are doing all right.
The S&P is off more than 8% since its high in early January. So we, Rob, can't really find much stability because we just don't know much of anything at this point other than the Strait of Hormuz is still closed. Oil prices are still moving higher. Yields have entered the building. And Fed talk is more hawkish. Market expectations of Fed activity has moved more hawkish. So what do you do with all of that? Because I would submit that right now, oil and yields have way more sway over this market than the president backing off a threat like it's a tariff decision. Because this isn't that. Barclays addresses that as well today. They say, quote, headline fatigue is starting to undermine the Trump put efficacy. Trump's apparent willingness to de-escalate the conflict has kept equity markets afloat so far. The risk is that constant flip-flopping and headline fatigue is starting to seriously undermine the efficacy of the Trump put. Now, I don't think anybody believes that the so-called Trump put is dead. I still believe that they think it's alive and well, and for good reason. But this isn't tariffs, okay? And it's very easy to make, according to Goldman's Tony Pasquarello, who published just before we came on the air today, you could make a very tactical bull and you could make a tactical bear case in the same way. It's not like Steph is wrong, because you can make a tactical bull case, but you can just as easily, for the first time in a while, make a real easy tactical bear case too.
And there's a lot of asymmetry on that. I think the bull case certainly can be made. There's probably less upside to the bull case. I think the bear case, if it plays out really negatively, could play out much worse. I find that what's kind of most interesting in all of this is that despite the pressure that we're seeing from energy going up and the implications on helium and the implications on semis with helium and all the derivative impacts of petroleum-related products.
Grain costs, food prices, input costs, all across the board.
Everywhere. At the same time, you have credit that while it's not tightening as much as Steph said, it's certainly tougher to get from private credit firms who aren't raising the money that they used to raise. So that's kind of a separate issue, right? That is the fuel that has fueled this economy for quite a bit of time. And yet, in the face of all that, markets have re-rated from a 24 PE down to a 19 PE. In technology specifically, where most of the exciting growth comes from and most of the forward growth is coming from, Scott, has re-rated down to a market multiple of 19.
Yeah, that's what would happen when the NASDAQ enters a correction like it did earlier this morning. It's down 10%.
And it's down 10%.
From its high.
And so when I look at where the opportunity is, it is in upgrading the quality of your portfolios, right? And I think cyclicals are going to be a little more dangerous because of the pressure on rates to stay higher, because the economic pressure on the consumer, which is real. Okay.
I want to stop you just for 2 seconds, okay? On the notion of, quote unquote, upgrading your portfolio, because in this current environment, there's been no real way to do that unless you're in cash. There's been nowhere to hide. FT today with a headline, the traditional 60-40 portfolio of global stocks and fixed income having its worst month since 2022. That underscores the fact that there really has been nowhere to hide in this market.
There has been absolutely nowhere to hide except energy, as you said. We're thankfully
sure, but I mean, you know, what is that? 3% of the S&P 500.
We're overweight energy. We're certainly overweight the names that are most attractive in some of these spaces. Yes, some of them are getting hit, but others have held up incredibly, relatively well because we started from a lower base of a valuation standpoint. Most portfolios for clients are flat for the year, which shows you we've had a broadening out. There's been some success. There's been some headline damage. But if I were to talk to clients about what to do, I'd undulate the accelerator right here, see if you can get a little more visibility into what's going to happen.
What do you mean? Like, just
slow down
back a little bit.
Slow down if you have cash to put the work.
Okay.
I'd slow down, but I would be at the ready. Because we know that the number one bet we've been able to make over the last several years is don't bet against the White House. And that's not a political statement.
I know exactly what it is. It is the idea, as why I suggested that nobody is saying, even in an environment with so-called headline fatigue and maybe the market not paying attention to every word out of Washington over the last 24 to 48 hours, don't discount the ability of a headline or a social media post about a breakthrough regarding anything to dramatically move this market. I think everybody agrees with you on that. Now, in terms of pulling back a little bit, cautious, taking a look around through the fog and trying to figure out what's up. Citi's global asset allocation today, they cut equities to neutral because most of their negative equity signals are triggered. So they're just taking a step back and saying, you know what, like everybody else, we're not ready to make a call to play offense or not even necessarily to play defense. Just kind of wait and see.
I strongly agree with wait and see. I'm not quite as negative as Citi is. I will agree, and we're all saying the same thing. There are a ton of cross currents here. Yes, West Texas Intermediate is up. However, Dubai and Omani spreads are down. The spreads are all across the board. Friday, this is the fourth Friday in a row that we've been down. Does that mean that this will be the fourth Monday in a row that we're up? Nobody knows. And the right thing to do is to sit on your hands right now, not make any large moves. Don't get scared and panic right now, and be careful about thinking this is a great opportunity. There are a number of military assets, U.S. military assets, being moved in theater. This president has a history of not bluffing. I mean, that's just a fact. He has used these assets when they are moved in theater. So I would be cautious, but not to the point of selling anything. And one saving grace here that we haven't talked about is what's going on with earnings estimates for the S&P 500 overall. Those estimates are up 2% over the month since the conflict started, and they show 16% growth year over year if they come to fruition, which versus a 20 times forward multiple, I would say is actually a bargain. Will those come to fruition, those earnings estimates? Part of it's energy. Part of it, energy estimates have rocketed higher, but a lot of it is artificial intelligence build out still, and I don't think that's going to change.
What do you think?
Well,
you heard everybody in their perspective. How do you see it?
I mean, we came into the year expecting rate cuts, and in the opening you were talking about us thinking about a 50% chance of a rate hike, and that's what breaks the earnings momentum. If we have inflation that affects the consumer, which we're already seeing with energy, if that trickles into corporate margins and ultimately earnings, then we have a problem. So I like Citi's call of pulling back and going neutral. I like what Rob said. It doesn't mean trying to time the market. That's a fool's errand. But I think having a little bit of dry powder, being able to buy the dips, but lowering expectations. I can't imagine that earnings aren't going to come down if we're sitting here a month from now and nothing's changed in the Middle East.
I think
this is a good point.
Kev nails it.
This is a very good point.
If you're talking about your input costs going up for a broad range of things, not just fuel, but if you're talking about the grain disruptions and a disruption to the food supply, you're talking about a whole bunch of different kinds of companies whose margins could be negatively impacted. So if you have higher inflation, higher rates, margins come down, multiples come down, which means stocks don't deserve to trade at the levels that they're trading at now.
What if you
they need to reset lower too.
What if you have higher productivity? What if that actually comes into play?
You're probably going to have that. You already are.
You are, but what if it actually accelerates because of all the technology, because of AI? The companies are telling you that they are seeing massive cost cuts because they are implementing AI. AI gets a bad rap on terms of the labor market and taking jobs, but no one really talks about the growth plus the productivity piece. And if you get more productivity, that will help to mitigate. It is not going to offset every single line item from expenses, but it certainly could be a partial offset. And I just don't buy that companies are going to take the hit on margins. They'll figure out ways to restructure and cost.
They might not have a choice. I mean, they're going to have to potentially. They might have to potentially take it initially. You're suggesting, well, they would just restructure so fast. No, that's not how it's going to work if their energy prices and transportation costs and everything else are going up. But what about the notion of where to hide or how to play it? And where I tell you that 60-40 off to its worst month since 22. Other firms are cutting things to neutral. Michael Hartnett over at Bank of America with the Flow Show, I think sums it up pretty well. Quote, in a good market, when the index falls, he's talking about the S&P, in a good market, when the index falls below its 200-day, investors cover their shorts. But in a bad market, that's when they sell their longs. By the way, data to back that up, U.S. equities, $23.6 billion worth of outflows. That's the largest in some 13 weeks. So people are walking.
But the distinction between a good and a bad market, quite often we're thinking about that in terms of fundamentals we can understand, which we've talked about, earnings, rate hikes, those sort of things. The distinction right now between a good market and being below the 200-day and a bad market being below the 200-day is the fog of war, which is just simply unpredictable. And we've seen it. We've seen it on Mondays where he comes out with a tweet or something changes. And regardless of whether it's real or substantive, it moves the markets. So you just have to be be prepared. If you want to get negative, I'm not on the markets, okay? I'm not getting negative. If you want to, you just need to be prepared.
Are you sanguine?
I'm
what are
hanging
you?
in there. The only thing I can say is I'm hanging in there, Scott. I don't like what's going on with oil. I don't like any of these discussions, nor should I, about rate hikes.
I mean, were you getting I'm trying to figure out, like, what does that mean? I'm not getting negative on the markets.
I'm hanging in there. I'm fully invested, and I'm hanging in there. I don't feel good. I don't feel good. But I'm not, and I wake up every morning. Should I sell something this morning? Nope. I'm not doing it. I'm not selling.